Howdy, y'all. Welcome to Liberty Call. Today is Monday, April 29, 2024. Hope you are having a fantastical day out there. Pretty decent day in the markets. See a lot of green on the screen across most of the globe. So I guess the markets were in a better mood. We do have a Fed meeting coming up, starts tomorrow and then on Wednesday, May 1st. So we'll see what comes out of that. I'm sure a lot of people are on pins and needles, hoping and praying that the Fed will start lowering rates, which, you know, until stuff gets really nasty, I just don't think that's going to happen. So, all right. Well, if it is your first time watching Liberty Call, if you could give me some thumbs up, a like, share, subscribe, follow, and press the notification bell. Let's jump into today's numbers and see how things are doing. All right. Dow Jones was up 0.38%, 146 points, closed at 38,386. S&P 500 was up 0.32%, closed at 51,16. NASDAQ up 0.35%, closed at 15,983. The VIX fell 2.4% today. It's at 1467. Canada up 0.19. Brazil up 0.45. And Mexico down 0.05. In Europe, Germany was down 0.16%. The UK up 0.09. France down 0.29%. The Netherlands down 0.04. Spain down 0.48%. Italy up 0.14%. Switzerland down 0.11%. And Portugal up 1.03%. Russian exchanges split today. The MOEX up 0.28%. The RTSI down 0.43%. And the Asian market, starting out with the Nikkei in Japan, it was up 0.81%. Australia up 0.81% also. New Zealand up 1.24%. The Shanghai was up 0.79%. Shenzhen Component up 2.22%. China A50 up 0.64%. DJ Shanghai up 1.15%. Hang Seng up 0.54%. And the Taiwan weighted last closed at up 1.32%. All right. So that is the markets for today. You know, take the good with the bad. So, all righty, let's move on over to the weekly economic update and see what's going on there. Stock staged a choppy comeback last week as investors cheered positive earnings led by mega cap stocks. The rally came to pass despite fresh data showing a slowing economy and increasing inflationary pressures. Last week opened with a rebound rally as investors breathed a sigh of relief that Middle East tensions had eased. The market rally extended into Tuesday with investors cheering positive corporate earnings reports. By Tuesday's market close, the S&P 500 had gained 2% for the week. But investor enthusiasm didn't last as midweek saw profit taking in all of three averages. Rising bond yields threw a wet blanket on the market momentum. At one point, the yield on the 10-year Treasury note rose more than 40 basis points from its low earlier in the week. On Thursday, markets slipped on two fresh pieces of economic data: gross domestic product slowdown and higher consumer prices. But by midday, selling pressure slowed. Stocks pushed higher on Friday behind upbeat Q1 reports from two mega cap tech stocks, helping the S&P 500 and NASDAQ post their best week since November. All right, let's go a little further down here. Earnings versus inflation. Corporate earnings and economic reports battled it out last week. In the end, earnings won, at least for this week. The big economic news was that Q1 GDP grew at 1.6% annualized rate, slower than the 2.4% economists expected, and less than the Q4 for 2023. The GDP report seemed to support the Goldilocks economy theory, not too hot, but not too cold, as a story investors have favored this year. The PCE, Personal Consumption Expenditures Index, the Fed's preferred inflation gauge, was embedded within the GDP report. Excluding food and energy, it increased at 2.8% from a year ago. It was unchanged from February and slightly higher than expected. It joined a growing list of factors pointing to an uptick in inflation, complicating the Fed's interest rate decision. Yeah, they're not lowering rates. Economic data this week. Tuesday, we have the Employment Cost Index, the Case-Shiller Home Price Index, and Consumer Confidence on Tuesday. Wednesday is the FOMC announcement and the Fed Chair press conference, Treasury refunding announcement, the ISM Manufacturing Index, and the EIA Petroleum Status Report. Thursday, motor vehicle sales, jobless claims, international trade in goods and services, factory orders, and productivity and costs. And Friday is the employment situation. Got a bunch of companies reporting earnings this week. Starting on Tuesday, it's Amazon, Eli Lilly, Coca-Cola, AMD, McDonald's, and Starbucks. Wednesday is MasterCard, Qualcomm, Pfizer, and ADP. Thursday, Apple, Amgen, Booking Holdings, ConocoPhillips, Cigna, and Friday is Berkshire Hathaway. All right, so a pretty full week on the agenda for got the Fed meeting, got a bunch of earnings from large companies. So by the end of the week, things could either be great or terrible. All right. Let's get over to the market recap. U.S. stocks rise, led by Tesla ahead of the Fed meeting. Let me get my notes here. U.S. stocks climbed on Monday, driven by strong performances from Tesla and Domino's Pizza, while investors continued to process a wave of corporate earnings reports in anticipation of the upcoming Federal Reserve meeting. Tesla shares surged 16% following reports that the company had received preliminary approval from Beijing to launch its driver assistance software in China, a development leveraging technology from Chinese tech giant Baidu. This news underscores Tesla's efforts to expand the adoption of its self-driving software, which is viewed as integral to its long-term growth strategy by many analysts. Domino's Pizza also contributed to the rally in consumer stocks after reporting better than expected first quarter sales, propelled by a 6% increase in same-store sales driven by customer engagement with loyalty programs. Meanwhile, SoFi Technologies experienced an 8% decline in its stock after issuing a disappointing second quarter forecast, despite posting strong revenue and income figures in the previous quarter, particularly driven by its financial services and technology platform segments. Looking ahead, earnings season remains in focus with upcoming reports from Amazon, Coke, AMD, and Eli Lilly scheduled for Tuesday. Apple's stock rose over 3% after receiving an upgrade from Bernstein, which cited improving demand in China as a positive driver for the tech giant. The Federal Reserve will begin its two-day meeting on Tuesday, expected to conclude with no change in interest rates. Investors are closely monitoring Fed Chair Jerome Powell's remarks amid growing speculation that any rate cuts might not occur until September or the fourth quarter, given persistent inflation concerns and resilient U.S. consumer spending. Recent data, including the hotter-than-expected March PCE price index, has reinforced expectations that the Fed will maintain higher rates for a longer duration, casting doubts on the possibility of imminent rate cuts. Yeah, I don't see the Fed doing anything. And like I've said multiple times, until there's a reason, the Fed's not going to do anything. And I mean, if the economy was starting to, slow down and stall, or prices were coming way down, I could certainly see why you could, lower rates, and they would have, little or minimal effect on the cost of goods and services. But until that time, we talked about it. It was either last week we were covering an article or week before that, the expectation is there may only be one rate cut, and that might be at the end of the year. So they've gone from like 4 or 6 that they were speculating on, in the first quarter and, fourth quarter last year, down to 1. I mean, again, there's no reason to lower rates. I mean, if the economy is as good as the Biden administration claims, which, we know they're full of BS, there's no reason to lower rates. And, if the economy is as bad as they say it is, that other people speculate it is, we know that. So which is it? Like they said earlier, it's kind of that Goldilocks situation where it's not hot, it's not cold, but it's not great. So, and things are still way too expensive. All right, moving over to our last article of the day, comes from our friends over at First Trust. This week's article is titled "The Worst Malinvestment," and it's written by Brian Westbury, their chief economist. All right, Austrian economics emphasizes the economic growth stems from innovation and entrepreneurship, guided by market forces that allocate resources to areas with the highest returns. This perspective warns against government intervention in markets through interest rates, subsidies, or taxes, which can lead to malinvestment. Investments in areas that would not be economically viable in a free market, resulting in wasted resources and losses. So basically, every federal employee is a malinvestment because they don't provide any services. They don't produce any goods or services that's used by the public. They're basically just a sinkhole of money that goes into it. Yeah, they spend their incomes out in the economy, but you got to think, for every dollar that goes into the treasury, how much actually comes out the other end in the economy? It's very small. All right. Recent events on college campuses highlight a form of significant malinvestment in the education sector. Public and private universities, including Ivy League institutions, have received substantial federal grants and contracts amounting to $33.1 billion between 2018 and 2022. Moreover, the government has provided $1.6 trillion in loans to young individuals for higher education, creating a significant economic burden and potentially fueling academic growth without tangible innovation or societal benefit. Parents out there, save your money. Do not send your kids off to college. Let them learn a trade that's actually useful. The narrative questions the value of traditional college education, suggesting that attending college primarily signals a natural intelligence, conscientiousness, or conformity to corporate norms rather than essential knowledge. Research indicates that many bachelor's programs yield negative returns on investment or ROI, contributing to the student loan crisis. So yeah, I mean, if you go out and borrow $50,000, $100,000 for an education, and that education does not provide you with the skills to earn you a job that you can pay that loan back off, bad ROI. The economic realities of malinvestment in higher education could be linked to the unrest on college campuses. Yeah, because they're not learning anything, just basically daycare until they're 22 or 23. A slower economic growth resulting from misallocated resources and increased debt burdens undermines living standards. To address this issue, separating academia from government influence is proposed. This separation could involve universities assuming responsibility for unpaid student loans and reducing government subsidies to institutions with substantial endowments. Ultimately, reducing malinvestment in education is seen as essential for achieving better economic outcomes and living standards. Yeah, that's something I don't understand. How come the government wants to tax me more to pay off the student loans of idiots who got a loan that they couldn't pay off? They didn't get a job that actually could do it. Why aren't they going after the universities that have these huge, endowment? I mean, I totaled it up years ago, and it's, a huge amount of money. I mean, they could probably pay off a good portion of these deadbeats who have these college loans and, take it from the universities. They're the ones who got rich off of it. I didn't. I mean, I got nothing out of it. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope everyone has a wonderful evening. And like I said, if you need anything from me, go to the website. Hope everyone has a good evening, and I'll talk to you next time. Adios.